Well, Europe's looking awful. China's starting to look a bit better. China's manufacturing sector in November reflected expansion for the first time in 13 months. The China HSBC Flash Manufacturing Purchasing Managers Index rose to a 13-month high of 50.4 in November. For more on this and other global news, we're joined from London by Michael Hewson, market analyst from CMC Markets. Hello, Michael. So we saw the markets responding, the US markets being closed, but the rest of the world responding rather positively to these numbers. Is this too soon to react?
Yes, I would say that it probably is a little bit premature at this point. If you cast your mind back to about a year ago, the HSBC PMI posted a similarly positive number around about this time of year after 3 negative months, and then proceeded to go back down again. So I'd like to see 2 consecutive months of expansion. The last time we saw that was in May 2011, and then I'd be a little bit more cautious, a little bit more optimistic. What I would say is that the industrial production figures, the retail sales figures, and the GDP numbers have been slightly more encouraging out of China over the past month or so. So we're probably heading in the right direction. I think the big unknown for me at the moment is the new Chinese government and what sort of agenda they will have. But I think in the short term, I'm sort of a little bit optimistic, but I'm not going to go all in quite yet.
So, Michael, uncertainty of the stance or the approach from this new government, but is the overwhelming conclusion then that policy easing will continue in China?
I think with respect to these numbers, probably not in the short term. I think these numbers are just about good enough for the central bank to remain on the sidelines for certainly in the next 2 or 3 months. I think if the data starts to edge back down again, then we could well see maybe the central bank come back in again. But as I say, I think the Chinese export markets in particular will need to keep a close eye on them, particularly Japan and obviously Europe, which has been a bit of a drag recently and probably will continue to be so.
So the reference to Europe, we had some numbers out, Bridget?
Michael, just a quick question. With regards to the new government coming in with China, what are your risk factors that you're concerned about, with regards to these uncertainties, etc.? Because now we're starting to see a bit of a trough formed. We've seen consecutive data that's shown us that there is some form of growth from that economy that's by and large being punted as the potential to get us out of this crisis. How do you feel about that?
Well, at the moment, so with any new government, there's always a little bit of uncertainty, certainly with respect to how they're going to react, whether they'll continue the slow reform agenda that the previous government was sort of looking at. I think that more than anything is really the key uncertainty from as far as I'm concerned. I certainly don't think they're going to do anything too drastic with respect to their engagement with the outside world. I will certainly be looking to see whether or not they will escalate this dispute with Japan, because Japan is a key market for them and vice versa. I think it's a little bit too early to tell how that will play out, but certainly as far as policy going forward is concerned, I'd be certainly interested to see whether or not the People's Bank of China changes policy with respect to further easing if there is a slowdown. And at the moment, we are seeing a little bit of a pickup. Let's see if that continues.
Michael, the other important export market, as you said, Europe, and another batch of numbers out today gives us no reason for any optimism on Europe. And meanwhile, we've got the budget talks going and a deal with Greece, hopefully, perhaps imminent.
Yes, indeed. I mean, these budget talks, I think we could wait probably another 7 months before we actually see any progress on there. I think it's a little bit too early. It's the budget for 2014 to 2020, so there doesn't need to be an agreement on them this weekend. It's more than likely we'll see an agreement next year. The bigger question, I think, as you rightly said, is Greece, and whether or not the Greek government gets its new money. And I think there is a sort of an acceptance that they probably will be in agreement in the next few days. I think if there isn't, then we could see a very sharp sell-off just as quickly as we've had this quick rally over the past 2 or 3 days.
Michael, how does one position oneself, or what are you advising your clients how should they be positioning themselves? I see various houses are taking particular bets, such as taking the bet that Europe will indeed recover from here, perhaps not a popular view.
It's not my view, I can tell you. I mean, most of our clients are positioned very defensively. You talk about defensive stocks, and obviously SAB Miller's one of them. Certainly most of our clients are sort of looking at that sort of area, high yielders that generally give you certainly give you a good rate of return, a good rate of yield in a low interest rate environment. If you look at what the FTSE's done over the past 2 or 3 months, it's pretty much gone sideways. So I certainly think that there's more scope for further central bank intervention, given the fact that we've got the uncertainty of Greece. Is Spain going to ask for a bailout? Probably yes. And does the US, or will the US, avert the fiscal cliff? I think at some point they will come to an agreement in the US with respect to that. The only question will be, what will be the level of spending cuts and tax rises that kick in from January the 1st? Will it be the full $600 billion, or will there be a compromise of, say, about $200 or $300 billion? Whatever there is, that will impact US growth.
Michael, thank you. Good talking to you. Michael Houston is a market analyst from CMC Markets. We were talking to him from London. Rory, coming back to you, so we know it's tough deciding on the nature of one's global exposure, the asset class, the region. It seems that some high yield bonds have done rather well, including corporate bonds, and that may not have been predictable from the outset.
Yeah, well, I mean, you can also pick over the entrails a lot more, and there's a lot more noise to give you the tools to do it. Or should we say tools, more of a vexation than anything else. I mean, a big one, of course, is China really recovering or not? Some will say recovering sluggishly, some will say in the bin, some will say will rebound easy pie.
And that would determine your commodity view?
Absolutely, absolutely.
Bridget, what are you, on the currency side, what are you proposing?
Well, there's a couple of issues. I mean, with South Africa specifically, as he was mentioning earlier, is that the South African bond market is a good indicator as to how foreign investors view the carry trade opportunity, and that continues because nothing's really changed globally. We still have the issues in Europe. The peripheral issues have not gone away. We're still having funding issues. We still have low growth, and that doesn't seem to be sorting itself out. Now what we're looking at is budgets going out 7 years post 2014, really looking at that long-term growth perspective and how they're going to manage the increasing debt levels and the uncertainty. But more importantly, and I think what we need to consider is, you know, we've got the fiscal cliff coming up. Does the US or doesn't the US go into recession post their agreement around how they're going to deal with the fiscal cliff? Because 2011 we had a similar scenario where we were looking at pushing the ceiling higher again. So these kind of implications, as well as Japan remaining negative growth, etc., these are all implications that are not going away and are not being remedied. And unfortunately, the knock-on effect to that on emerging markets is a low growth scenario, yet we have a higher yield, so we attract foreign flows. Now, from a South African perspective, the only anomaly is that although we've attracted foreign flows, the hedging on the back of that to protect yourself against the volatility in the rand has meant that the rand hasn't necessarily gained despite what we've seen in other emerging markets. So it's actually underperformed what we've seen in other emerging markets. It's been fortuitous for investors because they've got better rand value in terms of investing. However, it does signify that the underlying fundamentals are still something that investors view as something to be cautious about, as well as the fact that if you look at other emerging markets, there's a stronger exchange rate. However, in South Africa, despite the fact that we've got a weaker exchange rate and there's all these talks of currency wars, we're not able to maximize on that. Why? Because our manufacturing productivity, etc., and competitiveness is not attractive in terms of our exports. So these are anomalies that we need to get right in terms of empowering ourselves in this kind of environment.